Hello, everybody, and welcome to Pursuing a Better Investment Experience, where I will review 10 important principles for long-term successful investing. Once again, I'm Sergio Mariaca, and just as in my other videos, I try to break down some of the key principles around investing and wealth management in a way that is understandable so that hopefully you can be a more informed and disciplined investor. Now, effective wealth management is a complicated and dynamic process, and your portfolio is just one piece of that puzzle. So in this presentation, we're going to focus on portfolio design and drill into the science of the drivers of investment returns. Now, before I get started, I need to tell you three important things. First and foremost, we're going to be reviewing historical performance, and I need you to know that past performance is never a guarantee of future results. Next, everyone's situation is different, and this information is for general purposes only. It does not constitute investment advice or a recommendation of any kind. Third, much of the data and insight that I'm going to be sharing comes from Dimensional Fund Advisors, one of our principal investment partners, who are widely recognized for their rigorous application of academic research into their investment solutions. So if you happen to be one of our clients and you find this content compelling, don't worry, you are already likely taking advantage of it. So as I'm recording this video, it's October 6, 2020, and we have just about a century of stock return data in the US, where we have seen every kind of economic backdrop. From the Great Depression to high inflation rate environments, low inflation environments, high interest rates, low interest rates, negative interest rates, and about 15 recessions along the way. In fact, as I'm recording this, we just surpassed over 210,000 American deaths related to the COVID-19 pandemic, which has also impacted our economy, so we have pandemics too. So in the past 94 years, through changing economic cycles, U.S. stocks have continued to reward long-term investors, averaging just about 11% per year. By far the highest long-term rate of return for all alternative investments. It's a fairly simple story, but it's not that easy, because just like today, the market has periodic environments where it becomes very challenging to be an investor, because these periods test our convictions around our investment philosophy, our processes, and of course, they also test our resolve to be a long-term and disciplined investor. Now, the good news is that we also have decades of academic research, and we can use this information to work for us and hopefully improve our long-term results. Now, before I jump into the slides, let me start with an important concept that has applications beyond investing. And I'm speaking of trade-offs. Today, there is virtually an infinite number of investing strategies that you can pursue. And you need to understand that just as with all decisions in life, investing is all about trade-offs. For example, if you want a long-term market return, you have to know and expect years where you are going to be disappointed and your portfolio will be down. Conversely, if you want absolute safety and preservation of capital, you have to expect a very low yield going forward. So regardless of which investment approach you take, hopefully you understand the trade-off and the implications of your strategy in a way that allows you to remain disciplined and confident during volatile periods, because that's when it matters most. Okay, let's go ahead and get started and look at principle number 1. Embrace market pricing. So why do we want to embrace market pricing? Well, I believe the alternative is almost impossible, and I think the data bears that out. Okay, global stock markets facilitate our free market system, which is the cornerstone of capitalism. And in 2019, on a daily basis, an astronomical amount of trading volume occurred. About $450 billion worth of securities traded hands each market day. And that adds up to about $112 trillion with a T over the course of all of 2019. Truly a huge amount of trading activity. And what the market does so efficiently is it integrates the combined knowledge of all participants within these trades, all the buys, all the sells, and it sets the current price. Now, of course, there are those investors who hope to identify mispricings in the market consistently and convert this knowledge into higher returns. Let's see how successful they are. I believe there are more reliable strategies to increase your expected return, and we are certainly going to be covering them in this presentation. All right, let's look at number 2. Don't try to outguess the market. As I suggested in the previous slide, it is really difficult to find mispricings in the market. So let's take a look and see how some of the active mutual fund managers fared from 2000 to 2019. That's 20 years of data. We're going to be looking at active professional managers. You can think of them as mutual fund managers in the equity space. Some of these might be global managers, some of these might be domestic managers. And on January 1st, 2000, we had a population of 2,758 of these active managers. Now, I think we all know that there's some pretty smart folks on Wall Street, some of them with limitless resources, which they use to try to exploit mispricings in the market and deliver higher returns to their clients. So let's go ahead and see how they did. Well, at the end of 20 years, only 41% of the original 2,758 managers are still in business. Of course, some of them may have merged into different mutual funds, but many of them also had to close shop because their performance was so horrible that they couldn't hold on to their clients. Now, let's see what percentage actually outperformed the benchmark for the whole 20 years. Only 22%, which means that 78%, almost 4 times as many, underperformed the index that they were competing against. And so if these folks can't do it with all of their resources, what are the chances that individual investors or even individual brokers are going to be more successful? I'm not sure it's very good. Now, as I also suggested in the previous slide, I believe there are more reliable strategies that we can adopt to increase expected returns, and we are certainly going to cover those in future slides. Principle number 3, resist chasing past performance. And in the previous slide, we show how difficult it was for professional active managers, mostly mutual fund managers in the equity space over 20 years to outperform the index they were competing against. Now, we know that many investors, when they're picking their managers, when they're picking their mutual funds, they look at previous performance, and the assumption is that past top performers will continue to be top performers. So let's take a look at this a little bit differently than the previous slide. So we're going to look at 2 5-year periods, so a span of 10 years, and we're going to take the top quartile equity professional investors. We can call them mutual fund managers. Between 2009 and 2014, these are the top quartile performers in their equity space. Once again, they could be global, they could be domestic, they could be international, etc. And so we want to see, does top performance persist? And what we notice is, of the top quartiles for the period ending in 2014, only 21% were able to maintain that top performance between 2015 and 2020, which tells us that about 79% underperform. They can't continue to have top quartile performance going forward. And we're not even talking about beating the benchmark, because potentially, even if you're in the top quartile, doesn't mean you're beating your benchmark. So once again, it becomes very difficult for top performance to persist going forward. These are professional managers. They can't do it. Probably likely that individuals can't do it as well. So again, I think there are better strategies we can adopt. That's the whole point of this presentation. We're going to go ahead and look at those in a couple of slides. All right, let's go to number 4. So let's take a moment to recap. So we're going to embrace market pricing. We're going to try to not outguess the market. We're going to resist chasing past performance. So what are we left with? We're left with principle number 4, and that's letting markets work for us. So as I suggested in my opening, over the long term, capital markets have consistently rewarded patient and disciplined investors. This is a growth of wealth chart, and it shows various asset allocations, or asset classes rather, and how they have grown since 1926 through 2019. Let's start with inflation. Not really an asset. Inflation is a measurement of your purchasing power erosion over time. And what this is telling us is whatever you could buy for $1 in 1926, you needed $14 at the end of 2019. So at the bare minimum, we need to make sure that our assets preserve purchasing power and at least outpace inflation, which historically is about 3% per year. Next, we have guaranteed investments, and the safest investment on the planet is widely known to be U.S. Treasury bills. So $1 in 1926 grows to $22 at the end of 2019, outpacing inflation, but not by much. And next, we have longer-term U.S. government obligations, and $1 in 1926 grows to $175 with the U.S. long-term government bond. Now we start adding market risk, and as we notice, there is a huge jump in returns over time. So $1 in 1926 invested in the largest companies all the way through 2019 grows to $9,237, far outpacing anything we could get in these more stable and guaranteed asset classes. And then if we add small cap, $1 in small companies in the U.S. in 1926 grows to not $9,237 like U.S. large cap, but $25,617. And so we need to understand that there's a difference in historical return and therefore a difference in expected returns as we start adding risk to our portfolio. But we want to also understand that we need components of our overall asset allocation strategy to be safe and stable and reliable. But we also need some of that longer term risk to help us outpace inflation. We're going to get into more of this in the future. All right, let's move on. Okay, principle number 5, consider the drivers of return. And I've already mentioned it a couple of times in this presentation that I believe there are more reliable strategies, and I think the evidence bears this out, that we can use to increase our expected returns going forward. We're just going to focus on equities again, and I'm really going to drill into these dimensions of expected returns in future slides, but simplistically, we're going to focus on 3 of them going forward. And one is that small cap over time outperforms large cap. And we just looked at the growth of wealth chart where we showed since 1926 through 2019, small cap U.S. equities surely outperform large cap U.S. equities. We're going to explore this in more detail, even beyond domestic markets. The next one is that value companies, and I'm going to define what those are in a future slide, outperform growth companies. And so we're going to look at the evidence there as well. And then the last dimension, this is the newest one, is that high profitability companies continue to be high profitability companies, and as a result, we can screen for them because they, going forward, or historically speaking, outperform lower profitability counterparts. We're going to explore all of these in greater detail because this is really the purpose for this entire presentation, is understanding these drivers and how they can impact our future expected returns in our portfolio. Okay, let's go ahead and move on. Number 6, practice smart diversification. This comes back to this idea around home country bias. And unfortunately, we see too many investors maintain a home country bias without knowing if it's grounded in historical performance. And I'm really going to dig into this in future slides, but simplistically, oftentimes, and I've heard other investors tell me, listen, all I have to do is invest in the S&P 500, get exposure to the top 500 companies in the US market by market cap. They're all doing business around the world, so I get international exposure through those companies, but because they're domiciled in the United States, it's safer in one way or another. The fact of the matter is we need to understand if, historically speaking, we can do even better by considering stocks from international countries. So at the end of 2019, 54% of all publicly traded companies were domiciled in the United States, which means that there was about 46% outside of the US market that we could consider investing in. And what we're going to be looking at in future slides is, does it make sense? Does it enhance returns for us to consider investing directly into international markets? We're going to look at this in a couple of slides. All right, let's move on to number 7. Avoid market timing. Now, this is a quilt chart. I'm going to write in black because I think it'll be easier for you to see. And this shows the performance over several years of different asset classes arranged from lower return all the way to the higher return over a span of time. I actually have a more detailed quilt chart. So here we can see the top 22 developed international markets over the last 20 years. And if you are one of those investors that only invests in US domiciled companies, meaning you have that home country bias, over the last 20 years, the United States was number one time, underperformed international markets, some international markets, every other year. So maybe a better strategy, and we're going to really drill into the data around this in future slides, but maybe a better strategy is to consider owning the entire global market in a balanced and efficient way, of course. And that way, regardless of where the returns show up, you have access to them. Of course, you're going to have all the winners, and there's always that trade-off that you're going to have all the losers. But if you have a nice rebalancing strategy, you might be able to take advantage of it, because we see a lot of rotation in the losers. So, for example, back in 2000, worst place to be was New Zealand. Well, if that was the worst place to be in my portfolio, I know a lot of investors that would probably have sold out of New Zealand, but for the next 2 years, it became the best place to be. And we see that happen over and over again. Down here, here's Ireland losing for 2 years, and then a couple of years later, it's number one. I could do this all day long. 2016, Canada is the best place to be. Next year, it's the second worst place to be. New Zealand, worst place to be. 2 years later, once again, best place to be. So we have seen this over and over again, and maybe a better strategy is to understand the data and to try to see if it makes sense to maybe have some international exposure. If you remember, the U.S. market accounts for about 54% of global market cap. The balance of that, 46%, are companies domiciled in international markets. Okay, let's move on. Principle number 8, manage your emotions, and this is a huge one. Of course, we're all emotional about our money because it represents our security, especially if we're retired. But we need to know that if we want to pursue higher long-term performance, we're going to have to deal with periods of volatility when our portfolio may lose value. So we really need to understand the cycle of fear and greed there is truly nothing more predictable. And this is how it goes. So as asset values are increasing, emotional investors load up on risk because they think that environment and that period is going to last forever, and it never does. It's always followed by an economic contraction, a recession, a market correction, maybe even a pandemic. Asset values start falling, and those very same emotional investors start shedding assets because they believe that period is going to last forever. And of course, it never does. It's always followed by a quick recovery, typically. And because they're sitting on the sidelines, they miss out on the corresponding recovery. They end up locking in some losses, creating some taxes, and they really put themselves in a difficult situation. So we really need to understand how to detach our financial decisions from emotion so that we are not reactive investors. And I truly believe that it all comes down to having good education around our strategy and our portfolio, understanding how it performed in previous difficult environments so that we can have a higher level of conviction and we can remain long-term and disciplined when it matters most. This is really why I do these videos, because I want to make sure that our clients are educated in our process and in the science behind our portfolios. Okay, let's move on. Look beyond the headlines. And this is a really, really important one because we live in a very noisy world. And absent a strong investment philosophy to guide you, you will be more susceptible to media influence. And I promise you, it's not going to help you out. So we have to really resist all of this daily information that we get bombarded with that is really not helping us long term. And I love this quote, and I'm going to paraphrase it. It comes from Alan Abelson. And it says, being a long-term investor and listening to the market news every day is like a man walking up a big hill with a yo-yo and paying attention to the yo-yo and not the hill. And I think that is a great quote. And Alan Abelson, if you don't know who he was, he passed away a couple of years ago. He was a very influential financial journalist with Barron's magazine. So if anybody understood the intersection between a long-term evidence-based approach and the media, Alan certainly was that guy. So understand this and do your very best to look beyond the headlines. So number 10 is the most important principle, and we want to focus on the things we can control. So in life, there are things, and this goes beyond investing, there are things that are important, right? Lots of things are important when we talk about investing. Security prices are important, the economy is important, all sorts of different things. And then there are things that we can control. This is called a Venn diagram. And so, we can control lots of things. Now, if we truly want to pursue a long-term approach for higher returns, we really need to focus on the intersection between things that are important and things that we can control. And here are some of those items over here. So it all starts with an investment plan fit to our current needs and our risk tolerance. And I believe that also begins with an advisor who understands evidence-based investing and can help you formulate a plan that's going to fit your needs today and get you to where you need to be in the future. Next, we want to structure our portfolio along the dimensions of expected returns. We want to use those decades of academic research to help us improve our future outcomes. We're going to be spending some time on what those dimensions actually might do for us in the next few slides. We want to diversify globally. We're going to also look at some numbers there, some returns there. And if there is merit, maybe we want to question our home country bias if we have one. We want to always manage expenses, turnover, and taxes because they erode performance. So we want to drive those to zero, as close to zero as we possibly can. And then very important through it all, we want to stay disciplined and have a strategy where we have a high level of confidence because we're educated about how that strategy has survived previous market dips and swings. And I believe that also includes having a really good advisor who can keep us from becoming that emotional investor, which we all have the capacity to do. All right, so now we're going to drill into some of those areas that we can focus on that might have the greatest amount of impact on our long-term investing strategy. All right, first of all, again, we're going to embrace market pricing. We're going to resist chasing past performance. We're not going to outguess the market, and we're not going to market time. We're going to let markets work for us. So let's take a look. We saw this before. This is the growth of wealth chart. And there's a couple important things that I'm just going to point out because we pointed them out before. This is the safe stuff with guarantees, right? Very little risk. Here's the stuff with risk. Okay, so there is a big difference in the historical returns investors have achieved when they take on risk. And even within the risk, there's a huge difference between the return for large cap US stocks versus small cap US stocks. And we're going to explore that in the upcoming dimensions of return. All right, here we go. This is the distribution of annual returns going all the way back to 1926 through 2019. Everything in the red on the left of your screen, those are down years. Everything in the blue to the right of your screen, those are up years. I think we can just visually look at this and we can notice that there are a lot more up years than down years, and that's a good thing. And we have some statistics here. So 74% of the last 94 years, the market was positive. 26% of those years, it was negative. I also like noticing that, and again, these are just calendar years. The highest column for negative years are years where the market is down, and this is the broad market, between 0 and 10%. Conversely, the highest number of annual years where the market is up, it's up significant between 20 and 30%. And in my opening, if you remember, through all of these years, 94 years to be exact, the market averaged about 11% a year, even with those down years. Now, if we just count the positive years, the average return for positive years over this period, the market was up 20%. So when the market is up, it's up big. And so we need to understand this trade-off as a long-term investor because it builds confidence and allows us to stay in our seats when we have some of those down years. All right, let's move on. Next, we're going to consider the drivers of returns. This is where this presentation really gets interesting. In fact, it's the whole reason for this presentation. All right, you may remember me saying that I believe there are now more reliable strategies that we can pursue to increase our future expected returns. So we no longer have to try and outguess the market. We don't have to chase past performance. We can now embrace market prices and let markets work for us by starting with a well-diversified portfolio and using the decades of academic research to pursue even higher expected returns by emphasizing these drivers of returns. So let's go ahead and meet the drivers. We're going to focus on equity drivers, and there are 4 of them. The first one is that over time, stocks outperform bonds. And I think that is well known and generally accepted. So we're not going to spend a lot of time there. If you remember, we saw the growth of wealth chart and clearly stocks outperform bonds. The next one is the size premium. This suggests that small cap companies over time outperform large cap companies. So what is a small cap company? Small cap companies have a market cap between 300 million and about 2 billion. Large cap have market caps exceeding $10 billion. The third premium is the value premium, and this one states that over time value companies outperform growth companies. So what is a value company? A value company is a company whose market cap undervalues, or rather the company's book value exceeds the company's market value. So what is the book value? The book value is a company's intrinsic value. It's all of the company's assets minus liabilities, and that value exceeds the market value. So it's trading under the intrinsic value of that company, and that's a value company. Growth companies typically have a market cap that exceeds the intrinsic value of the company. There are other definitions. That's a simplistic one, and it's acceptable for this presentation. And then we have the profitability screen, and I shared with you before, this is the idea that we can now screen for highly profitable companies, and we have found that over time, highly profitable companies that remain highly profitable companies will outperform lower profitability companies. All right, we're going to look into data 1 year, 5 year, and 10 years, and rolling 5 and 10 years for all of these premiums. Now, in order to be a premium, it needs to be sensible. That means we need to see evidence that the premium actually exists. It needs to be persistent, so that evidence has to show up more often than it doesn't. It also has to be pervasive. We can't just see it in one market. We want to see it in different markets. So maybe not just in the US, but also in international developed, international emerging, etc. And then it has to be robust enough to make it worth pursuing. And of course, if it can't be pursued cost effectively, then what's the point? So it also needs to be cost effective. All right, so let's look at all of the data that we have for these premiums. And we're going to look at US stocks from 1928 to 2019, developed non-US markets and emerging markets. We have less data for both of those, but we're going to look at what we have. All right, so for US stocks, since 1928, small cap companies on average outperform large companies by about 2% per year. Value outperformed growth companies by about 3.18% per year. High profitability screens outperformed lower profitability companies, and we only have data back to 1964, by about 3.5% a year, by far the most robust U.S. equity premium of the three. We also saw these persistent and pervasive in other markets. So in developed non-US, small company outperform large company, value outperforms growth on average, and the profitability screen also adds value. In emerging markets, once again, small cap outperforms large cap, value outperforms growth, and profitability shows up as well. So perfect harmony, perfect persistency across all of these time frames. If this is all the information you knew, you would just buy small cap and value companies and call it a day and screen for high profitability. But of course, we know that there's trade-offs in investing. First of all, when we build portfolios, we start with a well-diversified global portfolio with large cap growth, large cap blend, large cap value, and we tilt it towards value. So we don't fully discount large cap growth, and we don't fully discount mid cap and small cap growth either. These are just tilts that hopefully emphasize the premium to access higher expected return. In the same way, we also have large cap, so we don't just have small cap in the portfolio as well. And the same thing for high profitability. We also have low profitability companies in these portfolios. We just screen and emphasize the higher profitability ones. But back to what I was saying, there are always trade-offs, and as we're going to see, there's not pure persistency across every time frame. There are time frames where these value premiums and the small premium and the profitability screen do not show up, And that's where we need to be educated and understand the trade-offs. And we're going to get into some of that data now. So just looking at yearly observations for U.S. markets, real clearly, small cap overgrowth. Again, we're not going to focus on T-bills, market versus T-bills, but small cap overgrowth. We know this number because we just saw the average. Large cap, no surprise, we saw this number as well. And then going back to 1964, profitability also shows up more often in yearly, in annual data. Looking at developed non-U.S. markets, once again, we saw these longer term averages. So we know that these persistently show up more often than not on average. And same thing for emerging markets. So let's jump into 5 years. What we want to see is as we have more years, we want to see even more persistency of these premiums. And I think this is what we see here. We see this is U.S. markets, small cap outperforming large cap. We see nice bunches of 5-year periods. Of course, there are periods that underperform. We expect those kinds of things. It's part of the trade-off equation that investors need to understand. And remember, in these situations, not as if we don't have large cap focus. In fact, most of our portfolio is in large cap. We just have these tilts towards small cap. But more often than not, and that's the important thing, we get a premium by tilting towards small cap. And so that's what we want to do to build efficiency, to be able to harness increased long-term expected returns. All right. When we look at 5-year premiums, value minus growth, even more persistency, longer periods of 5-year periods. Look at this one. Of course, we still have, looking at the last set of years, many 5-year periods where this premium did not show up. And this is why you have to be a disciplined investor. Again, it's not as if we don't have growth exposure. We do. We just have these tilts. When we look at profitability over 5 years in U.S. markets, we see much more consistency. There are a couple of 5-year periods here and there. Here's a little span of 4 or 5-year periods, but generally much more persistent than the other premiums. Looking at developed non-U.S. markets, a little bit more persistency across 5-year premiums in the small cap space, value space, and the high profitability as well. Looking at emerging markets, same deal, more persistency in emerging markets for all of these premiums as well. Going ahead and let's look at 10-year periods. And this is small cap outperforming large cap in U.S. markets. Again, we see generally more persistency than we did for 5 years. And we get some really long spans. The last 10-year period, it has been down. And you know what we see oftentimes in a period like this? Oftentimes investors will say, well, why do I even have any small cap in my portfolio? Because it's clearly underperforming large cap, and I would have done much better by having more exposure to large cap. And they totally discount this historical evidence that just occurred. So that's why you always want to take a balanced approach. You want to be educated about the evidence that your portfolio is built on. You want to understand the trade-offs that you're making, and you want to have a sense of how often you might expect based on historical performance, these premiums to show up. All right, looking at the value premium in U.S. markets over 10-year periods, look at this huge period of absolute consistency from the late 40s, the early 40s rather, all the way through 1997 or so. But again, investors would really just focus on what happened over the last several 10-year cycles, totally discounting this, also discounting this period, which started in about 2000. And we always have to understand the trade-offs and be educated. We're going to look at a little bit more data as well. When we look at high profitability over 10 years, since 1985 or so, it's been 100% consistent and persistent, and that looks great. All right, looking at developed U.S. markets, so developed international markets for these 10-year premiums. Of course, we see a lot more consistency, and that's what we would expect based on those original numbers that we saw in the very beginning. Same thing with emerging markets, even more consistent, again, with the value premiums not showing up over the last several years. And so, again, we just need to understand the trade-off there, and I've talked about that enough. All right, so let's look at rolling periods to give us even more data points. Using calendar years, we all know what a calendar year is. What a rolling period is, so if you just take 1 year, and a calendar year would be from January to December of that year, and that's just going to give you 12 months or 1 year of data. What a rolling period does is it actually looks at not only January to December, but it looks at that February to January, and that March to February, etc. You get it. So you create even more data points to analyze, because not everything operates on a calendar basis. So we're going to focus on small cap outperforming large, and we have 992 because of the rolling strategy. The way we use rolling periods, 992 overlapping 10-year periods. And what we like to see is, as we add more time, we like to see that consistency, that persistency increase. So 50%, 56% of 1-year periods, small cap outperforms large, 62% of 5-year periods, and 72% of 10-year rolling periods, small cap outperforms large cap in U.S. markets. Value outperforming growth. Remember, this is a little bit more robust than the size premium. So 59% of 1-year periods, 73% of rolling 5-year periods, and 82% of rolling 10-year periods, that premium shows up. And then high probability, which was the most robust of the three. We only have data going back not as far to 1963, but we see even more consistency, 64% of 1 year, 81% of 5-year, and 91% of 10-year rolling periods. That premium shows up. Looking at international markets developed for small cap outperforming, again, increasing persistency as we look at more time. So 5 years are outperformed by 10 years, etc. We see the same deal in value. Look at that rolling 10-year periods, about 98% of rolling 10-year periods, value outperforms growth. And look at this high profitability rolling 10-year periods going back to 1990. Not a lot of data there, but going back to 1990, it's 100% of the time that premium shows up. All right, emerging markets, same story. We've seen this. As we add more time, we have more persistency in these premiums showing up. That's what we want to see. Look at this profitability, 100% of 5-year rolling periods and 100% of 10-year rolling periods. That's data that suggests that not only are these strategies sensible, persistent, pervasive, but they are robust enough, as we saw in the previous data, to pursue. And Dimensional Funds is the company that focuses on these value premiums, and they do it in a very cost-effective way. All right, so the whole reason I'm showing you all of this great information is because, of course, there are periods where these premiums don't show up. And these are the periods that test our conviction. So looking at U.S. stocks, and we're looking at the years between 2010 and 2019. Small cap underperformed large cap by about 1%, a little more than 1% a year. Look at this, value underperformed growth by 4% a year. Still historically, there's a premium even with this number, but over the last 10 years, it did not show up. And high profitability is still consistent and pervasive across all of these markets, which is great news. I'm happy to report that small cap outperformed large in international developed and international emerging, but value across the board missed the boat. Now remember, It's not as if we don't have large cap, we do. We just tilt towards value, small cap rather. It's not as if we don't have growth exposure, we do. We just tilt towards value. So understand that it's not one way or the other. We actually have a broadly diversified portfolio. We're just trying to tilt efficiently to these premiums to generate higher expected returns going forward. And over longer term periods of time, the evidence suggests this is a compelling strategy to consider. All right, so if I line up all the 10-year periods, this is what it looks like. And if I asked you, would it make sense to consider this premium, the value over growth, and I'm only focusing on value over growth here, I think you'd look at this chart and you'd say, absolutely, this makes sense. Another interesting piece of information, and I don't know if it means anything, but here's our 10-year period that just ended in 2019. So one of the worst. Okay, that was unexpected. But the worst period was this one right here in 1930 through 1939. Well, you know what happened after that 10-year period? Well, a couple of years later, beginning in 1941, it was followed by the most robust 10-year period on average, where value outperformed growth by something like 12 to 13% for 10 years in a row. So, is that likely going to happen in the next couple of years? Who knows? It's just an interesting data point. We've seen that before, where underperforming securities become the top performing securities in future years, where underperforming value, I showed you on the quilt chart, underperforming developed economies become the top performing developed economies with respect to the stock market in subsequent years. So it would not surprise me if we see a really robust recovery in the value premium over the next couple of years. All right, so let's focus on smart diversification. And as we discussed, smart diversification is the idea around trying to avoid the home country bias and trying to figure out if there is evidence worth pursuing a globally diversified strategy over a home country portfolio. All right, so let's go ahead and compare the dimensional equity balance strategy. So this strategy has about 13,000 stocks in it, give or take today. And it has all the developed markets and all of the emerging markets, including the United States. The United States is the largest company in that strategy, or rather the largest country. And we're going to compare it with the T-bills, which doesn't make a lot of sense, but we really want to compare it with the S&P 500. And we're going to look at as many, remember with international, we don't have a lot of research, but we do have research going back to the 70s. So between 1970 and 1979, if you put $1 in the S&P 500 and $1 in the dimensional equity balance strategy in the beginning of this 10-year period, at the end of the decade, you would have $1.77 in the S&P 500, and you'd have $3.50 in the dimensional equity balance strategy. I think it's pretty clear that during that decade, you would have been better off to have some exposure with international markets as opposed to just your home country, assuming you are a U.S. citizen. All right, now let's look at the next decade. So the next decade, if you put $1 in 1980, at the end of 10 years, you'd have about $5.04 in the S&P 500. That is a really, really nice return, but I would prefer this return. I'd rather have an additional $2 or so. You'd have $7.32 from your dollar invested 10 years before in the dimensional equity strategy. So again, over these 20-year period, there was value in having international exposure. Of course, you know it's going to happen at some point, and let's see when that happens. Here it is. All right, so $1 in 1990 put into the S&P 500 would have grown to $5.33, similar to the performance in the previous decade. and $1 in the dimensional equity balance strategy would be $3.59. So you know what an investor would do after this portfolio performance over this decade? They'd say, why do I need any international exposure? Because the S&P clearly outperformed the more diversified international portfolio, and that's probably going to continue, and they would totally discount the previous 2 decades that we just covered. So let's look at the next one, and you guessed it, $1 in the S&P 500 in 2000 would have actually lost money, leaving you with only about 91 cents after the end of 10 years. We call that the lost decade. You would have at least doubled your money in that decade if you had the international exposure. So now we have four decades, and I would think at this point, if you were looking at all the decades, you'd see the value and the evidence to having some exposure in the 46% of stocks that are domiciled outside of the United States. All right, so then the next 10-year period, and this is our most recent one. This one has been a problem for some of the other premiums as we shared, and it's a problem for an international strategy as well. So $1 in 2010 would have grown to about $3.57 for the S&P 500, and you would have missed that performance if you went into a globally diversified portfolio. You would have underperformed. You would only return about $2.79, underperforming the S&P 500. So investors look at that today, and what do they say? They say, well, this is going to continue forever. I know what I need to do, and I need to just focus on the S&P 500. Okay, let's go ahead and put it all together. So once again, in 1970, we invest $1, and because we have a home country bias, we invest that whole amount into the S&P 500. So after almost 50 years, that $1 grows to almost $154. That's a pretty good investment. But had we taken a more diversified global equity approach, we wouldn't have $154. We'd have $529. And that is a huge improvement. And I've often found over time that those investors that have the home country bias, they do it for emotional reasons, and they really don't have any good evidence for why they're picking that particular strategy. And as I mentioned in my opening remarks, it's critical that regardless of what strategy you choose, that you understand the implications and you understand the trade-offs. Okay, so there you have it. Markets go up and they go down. And while we don't have a crystal ball, we do have the benefit of decades of academic research and financial innovation that we can use to build sensible and efficient portfolios. As I mentioned in my opening, your portfolio is just one piece of the wealth management puzzle, but it's one of the most important pieces for sure. And so for many, it starts with an advisor who can help you focus on actions that add investment value, including creating an investment plan tailored to your needs and based on your risk tolerance. Most importantly, your plan needs to be one that you can stick with when it matters most during volatile markets, because the longer your investment horizon is, the greater chance you have in realizing higher expected returns with equity premiums, value premiums, and profitability premiums. So tune out the noise, focus on the long term, and enjoy a better investment experience. Thank you for your time today. From all of us at Mariaca Wealth Management, we extend our best wishes to you and yours for a great fall season. We're going to see you again real soon when we release our third quarter market review, which will be out October 15th. And because we are in this crazy election year, I'm going to provide some more guidance and research around elections and party control. So please be sure to visit and like us on social media, and be well.